Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on today's market action because stocks, they are holding on to gains as the street does debate what today's reading on inflation means for Fed policy. Prices fell about 0.1% in December, but still up 6.5% from a year ago. We're looking at gains of about 229 points for the Dow, but you can see that mixed reaction and the fact that the Dow has been searching for direction at least shortly after the open today. A lot of that has to do with implications for Fed policy, but Dow right now up just about 0.6%. The S&P also holding on to gains, up just about 0.4%. The Nasdaq 100 up about 0.5%. The bond market action yields once again moving lower today, off about 11 basis points for the 10-year yield. We'll talk about some of that risk on sentiment, maybe from this inflation print. We have to look no further than what we see in the action in the price of Bitcoin. Bitcoin once again moving to the upside today. We're looking at gains of just about 7.5%, not too far from that $19,000 level. Let's dig into some of these movers today. You can see by looking at the Nasdaq 100 that the tech picture is a bit mixed. Nvidia, obviously an outperformer there, up just about 3.5%. On a sector basis, utilities, healthcare, consumer staples, the clear underperformers in today's market action. But energy, by far the winner, up just about 2%. Let's take a look at some of those energy names. Again, a lot of green here on the screen. You're looking at oil giants like Exxon, Chevron, up well over 1%, as well as BP and Shell there, Dave.
Talk to Mark Zandi about that shortly. Concerned about the price of oil. Shauna, thank you. Inflation continuing to ease in December. Some Fed officials don't appear all that satisfied with the rate of decline. Yahoo Finance's Jen Schomburger covers the Fed force, and she has the latest. Jen, what are we hearing?
Good afternoon, Dave. Fed officials weighing in on that cooler December CPI number and what it could mean for future rate hikes at upcoming meetings. St. Louis Fed President James Bullard called the latest CPI report, quote, encouraging, but said inflation is still high and appeared to favor a 50 basis point rate hike at the Fed's next policy meeting, saying that he liked front-loading policy. Speaking at an event for the Wisconsin Bankers Association, Bullard said, quote, I like the front-loading policy. I think if we want to get to the low 5% range, that we should go ahead and move to that level. I don't see the purpose of dragging things out through 2023. That doesn't seem to help us if the idea is to get to the right level of the policy rate and then allow that to put the downward pressure on inflation. But Philadelphia Fed President Patrick Harker said this morning he expects that eye-popping inflation readings of 2022 are behind us and that it makes sense to slow down the pace of rate hikes. Harker said in remarks prepared ahead of the CPI report, quote, I expect that we will raise rates a few more times this year, though in my mind, the days of us raising them 75 basis points at a time have surely passed. In my view, hikes of 25 basis points will be appropriate going forward. Now, markets are pricing in a 25 basis point rate hike for the next policy meeting on February 1st. Guys.
All right, Jen Schomburger, thanks so much. Let's talk about the inflation print, what that means for Fed policy. And we want to bring in Mark Zandi, Moody's Analytics chief economist. Mark, it's great to see you there. So certainly some improvement on the inflation print, right around 6.5% from a year ago. Conflicting commentary, though, coming from Fed officials. Bullard, on the one hand, saying that he's arguing for rates above 5% as soon as possible. Then you have the Phillies' Harker saying 25 basis points in his mind makes the most sense. What do you think?
Well, I'm more sympathetic to what President Harker had to say. I mean, I think the inflation numbers today were great. I think the job numbers we got last week were great. I think we've been getting very good economic data now for at least 2, maybe 3 months. And I think the Fed's done what it needs to do. So maybe a couple, 3 more rate hikes, 25 basis points each time. That would put the funds rate target somewhere around 5%, give or take. That feels about right to me. And I think the data between now and the next few Fed meetings will continue to support that. So I'm in the Harker camp that this is we're pretty close to the end of the rate hikes at this point.
Close to the end of it. Good to see you, Mark. So best case, what's the best part of this report? What's the worst or stickiest part of the report you saw today?
Well, the thing I really liked most about it was kind of a broad-based slowing in inflation. You saw food price inflation come in. Of course, energy prices declined. You saw declines in vehicle sales, including new vehicle sales. We've been waiting for that for some time. Supply chain issues have been the problem there, and they're starting to ease. Airline ticket prices were down. The medical care inflation remained relatively low. The only blemish, Dave, was in the cost of housing services. That still reflects the very strong rent growth we were getting back at this time last year. The good news there is that rents have gone flatline here, or going down in some parts of the country, and that'll start to weigh on the cost of housing services later this year, and we can say that with a high degree of certainty. So a lot more good news in today's report than bad news.
Yeah, that shelter number certainly is still significantly high. Mark, when we talk about seeing inflation continuing to ease, it sounds like you're pretty optimistic about that. What do you think is going to be the big driver lower in order to see significant improvement there? Is it all about housing?
Well, we got to continue to see oil prices stay roughly where they are, keep gasoline prices down close to $3 a gallon. If we do that, diesel prices continue to come in. That'll be really important in helping bring inflation down on a year-over-year basis through the mid part of this year. We're seeing new vehicle prices now head south here pretty quickly. Used vehicle prices are already falling. That goes to supply chains and goods prices coming in. That'll help on inflation through the mid part of the year. Second half of the year is all about the cost of housing services. That's going to decelerate. And then, of course, to get that last mile, to get inflation back to the Fed's target, we need to see the cost of non-housing services, which are labor-intensive activities like healthcare and hospitality. There we need to see some moderation in wage growth, and that'll bring inflation in. But I fully expect that by this time next year, I think the labor market's going to be soft enough, long enough that wage growth will have come in, and we'll get inflation back close to target or at target by spring, summer of 2024.
That's some great news. Got to do something about my bacon, egg, and cheese sandwich, though, Mark. I mean, eggs are up 60%, 60 in the last year, up 11 from the prior report. I know there's a lot factored in there, including the bird flu. I do want to talk to you, though, not about eggs, but about politics. President Biden spoke about this, mentioning the Inflation Reduction Act, which really had nothing in it to lower inflation, but he said Americans are starting to feel the benefits in their everyday lives. He also said this about the opposition party. Listen.
House Republicans campaigned on inflation. They didn't say if elected their plan was to make inflation worse.
All right, so Americans are seeing the impact of the Inflation Reduction Act, and Republicans' plans would make inflation worse. Either one true?
No, the truth is, Dave, inflation is coming in. Lots of good reason for that, and that'll continue to be the case. The rest of it is just is a bit of noise, political posturing. So don't think I'd read too much into that, but or anything into it. I mean, but at the bottom line is that inflation, while still painfully high, is moving in the right direction, and all the trend lines suggest that it's going to continue to come in. So by this time next year, I think inflation won't even be a topic, top of mind topic. Certainly not in political circles. Of course, there's a lot of things that need to get done politically between now and then that could, derail the economy, like the debt limit and the passing a new budget to fund the government after this end of this fiscal year. So there's a lot of work to be done. But on the inflation front, regardless of what's going on in Washington and all the Sturm and Drang, it's coming in, and we're going to feel a lot better about it a year from now.
Mark, what does all this mean in terms of the odds of a recession right now? I know you were out earlier this month with a paper saying that you're expecting a slow session, as you call it. Is that still intact? And what exactly does that mean?
Yeah, you like that, Shauna?
It was good. I liked it. It caught on.
Yeah, a little catchy. I was trying to figure out soft landing just doesn't feel
we're
right,
sick of that
right?
phrase.
I mean, it's not going to be soft. It's going to be uncomfortable. No matter what scenario we're talking about, it's going to be a difficult year. But slow session means, first of all, no recession. Means going backwards. And I don't think we're going to see a contraction in economic activity. We're not going to see a lot of lost jobs and very significant increase in unemployment. But we are going to see very slow, painfully slow, no growth, over the course of the next few quarters. That feels more like a slow session, not a recession.
You referenced what you see coming in inflation in terms of services when we're talking about shelter and rent. But what do you see in the housing market right now? And how concerned are you about something breaking given how lagging that data is?
Yeah, well, Dave, the housing market, obviously the single family housing market is the most interest rate sensitive sector of the economy. The Fed's raising interest rates aggressively to try to slow the economy. So it's not at all surprising that single family housing, the most rate sensitive sector of the economy, would take it on the chin. And it is in recession. It is, demand is down, home sales are down, home building is starting to weaken. And of course, house prices have rolled over. So I would expect more of that here over the course of 2023 and 2024. I think it's going to take a while and some meaningful price declines to restore affordability in that market, given where I think mortgage rates are going to land over the course of the next year or two. So housing is going to take it on the chin. I don't think, though, it's going to crash or it's going to be, break, as you say, just because the market is so undersupplied. The entire housing market, single and multifamily, vacancy rates across the housing stock are pretty close to record lows, and that puts a nice floor under prices. And also, the lending that's been done, the mortgage lending that's been done since the financial crisis because of the reforms after the crisis and that crash, mean that the borrowers are pretty good borrowers, and they have high quality, plain vanilla, 30-year, 15-year plain straight up mortgages, nothing fancy, nothing complex. And so it feels like we're going to see a correction in the housing market, and that's the script. But I don't think a crash is very likely.
Well, I know in an hour you're going to be watching our real estate special in case you didn't have your plans all set.
I know. 5
seconds. Where do you think mortgage rates land in your words? Are they in the mid fives?
Yeah. In the long run, they should be 5.5%. A 4% 10-year yield, add 1.5 percentage points, 5.5%. That's where they should be.
Wow, good guess I had there, Mark. You'll just check us out in an hour. Real estate special. Mark Zandi, good to see you, sir. Thanks.
Take care now.
All right, just getting started here on Yahoo Finance Live. Coming up, HBO Max's ad-free tier is going to be costing you more. We'll tell you what subscribers should expect. And Sam Bankman-Fried may be facing several criminal charges, but that's not stopping him from talking. In fact, now blogging. We'll tell you what he's saying now. And be sure to stick around for Yahoo Finance's aforementioned Real Estate Report special today, 4:15 Eastern Time. Please do not miss it. So how did the markets react today's CPI report? Well, quite frankly, initially they sunk. That was the futures when the numbers came out at 8:30, but you've seen quite a solid rally in the hour since as we absorb the numbers, and the Dow up about 0.5%. Slight gain for the S&P, up 8 points, and the Nasdaq up, again, slightly, about 40 points, but a nice green number based on a solid CPI report. Let's talk to Michael Jones, Caravelle Concepts CEO, about what he saw today. Mike, good to see you. Is this the market reaction you expected when you saw the CPI number?
It really is. It's kind of a lackluster response. There's a couple of good motivations for that. Number one, the S&P is bumping right up against overhead resistance. It's been in a very profound downtrend since the late summer, and it just hit overhead resistance on that descending downtrend, and that's a tough spot to get through. And it's particularly tough because this number was encouraging from every point of the dial for everybody except for the hawks at the Fed. We believe that the Fed continues to look at the wrong inflation indicators. These are the indicators that cause them to miss the building of inflationary pressures in 2020 and 2021. And now they're causing them to overestimate inflation pressures here as we move into 2023. That means the Fed is hawkish. They're on a relentless tightening campaign. And our rule is don't fight the Fed. When they're wanting to tighten, and you heard the St. Louis president say another 100 basis points minimum and really quickly, that's not an environment where you want to get aggressive in equity markets.
Michael, you mentioned the resistance levels that the S&P is up against right now. Let's start there, because we certainly have been, I think, a little bit surprised that the market wasn't more excited with this print. That next key level that the S&P needs to break through, what is that? And then once it does break above that, where do you think we're headed?
So right about where we are is that descending trend line. So if we can get another 20, 30 points higher than that, that'll be some ray of hope that we can at least break the trend line and start flattening out. But to really signal something important, something that might actually reverse this trend, we're looking more about 4,300 on the S&P, and that's a ways higher.
You say the Fed's looking at the wrong data. What would be the correct data, what you'd like to see them look at? And if so, does that mean they should pause now?
Well, and I would certainly be on the camp of pausing right now, because I believe that the creation of inflation occurs when the Fed funds massive deficits with printed money. Exactly what they were doing in 2020 and 2021. We saw a huge surge in money supply, 25, 26% growth. Fast forward to now, they have tightened dramatically and rapidly, and they're shrinking their balance sheet. That is sucking the money supply out of the economy. Right now, M2 is shrinking at about a 1 or 2% rate. We have never seen the money supply, as measured by M2, actually shrink, not since they began measuring it. And that is a powerful pulling of oxygen out of the inflationary fire. And yet they're ignoring it completely. What they're focused on is like the housing numbers in the inflation reports. Those housing numbers, as Mark mentioned earlier, they reflect housing inflation from a year ago. Yes, a year ago, they hadn't even started tightening and housing inflation was out of control. They were way behind the curve. Fast forward now, you look at market-based measures of housing inflation and everything is in a negative number. So I just think they're looking at the wrong things. They misled them on the way up in inflation. They're misleading them now on the way down.
So, Michael, certainly you think the Fed should pause, but it doesn't sound like the Fed is going to, at least over the next meeting or two or three. We'll see exactly what happens. What do you think investors then should do right now, given the uncertainty and the risk there that maybe the Fed does go too far?
So, first of all, before I become, typified as the great bear, there is a ray of hope. And that is, some of the other Fed decision makers who are starting to talk about a pause, or at least a drop down to 25 basis points, a time to see what's going on in the economy with all the tightening we've done. That gives you a ray of hope. If we can get inflation to keep falling and maybe even accelerate in the next 3 or 4 months, then you have a hope that some of those on the fence decision makers at the Fed can become full-blown doves, overwhelm the hawks, and get some rationality into Fed policy. But Hope is not a strategy. And right now, the message coming from the Fed and the majority of the FOMC is we're going to keep relentlessly tightening. As long as the Fed is sending me that signal, as long as markets, they came down a lot last year, but remember, 2021 was a real bubble year. We still have some room to make up in terms of getting back to fair value. So you put a hostile Fed and a pricey market together, and I still want to be cautious.
Hope is not a strategy. Luck is not a factor. Fear is not an option. Good stuff there. Michael Jones, thank you. All right, the ground stoppage that paralyzed essentially all U.S. air travel Wednesday is now fully accounted for, with the FAA saying in a statement, quote, "Our preliminary work has traced the outage to a damaged database file. At this time, there is no evidence of a cyber attack. However, the problem may not be entirely behind us." The president of the U.S. Travel Association, his name is Jeff Freeman, says, quote, "America's transportation network desperately needs significant upgrades," calling on lawmakers to modernize air travel infrastructure. Part of the problem here is, Shauna, as you know, it's become a political football, the FAA, and there's no consistent leadership between administration to administration. We'll see if we can ever fix that. But according to Flight Tracker, FlightAware, there have been almost 3,000 delays into and out of the U.S. today and 131 cancellations.
Yeah, I think the big question here is the time that it's going to take in order to update this system. Remember our guest yesterday, George Ferguson, he was a senior aerospace defense analyst. He was saying that in his guess, he thinks they have been trying to upgrade this system for decades, and it's going to take quite some time. So this could be a problem that you and I are still talking about for years to come.
Well, funding often gets stripped, and that's part of the political football aspect to it. I'm curious, with the billions of dollars in infrastructure upgrades we have coming, will Pete Buttigieg, who's come under a lot of fire for good reason in recent weeks, he's had a rough go, will he direct some of that money to upgrading an antiquated FAA system? I hope so.
And there's also been some calls for maybe leadership changes at the FAA as well. All right, we also want to talk about that despite these troubles, airline stocks, they're gaining today. And a lot of that has to do with American Airlines raising its fourth quarter revenue guidance, citing strong demand through the holiday season. The airline expects revenue to exceed pre-pandemic levels, forecasting 16 to 17% growth from Q4 of 2019. They also raised their adjusted EPS expectations to between $1.12 to $1.17. That's up from its previously forecasted 50 to 70 cents. American Airlines stock moving significantly higher today. Look at that. Gains of just about over 8.5%, nearly 9%. A number of its competitors, Delta, United, JetBlue, also posting gains today, Dave. And we talk about this time and time again, despite higher costs. Inflation print today up 6.5% still on a year-over-year basis. Consumers are adjusting their spending habits. One thing, though, it seems like people are willing to continue spending on is travel, because that demand from these numbers that we got, not only from American, from the updated guidance that we got from Delta in December, certainly shows that people are eager and willing to travel right now.
Yeah, and the number the airlines really love to use is a little bit wonky, but revenue per seat mile, they expect to be up 24% in the quarter from 2019. So that's 24% from pre-pandemic levels. To your point, people will spend. You can't help but wonder if the airlines are going to continue to raise prices on tickets. We'll get the earnings from Delta tomorrow to get a better glimpse at how much we are spending on travel. But yeah, it doesn't look like any pullback in sight based on consumer spending patterns, and a great report from American as their stock soaring today.
Yeah, and we'll get the full report from American on January 26th, but we've got Delta tomorrow, which we will talk about on the show. All right, well, coming up, Bob Iger facing his next big test as a new Disney drama unfolds. And Netflix's password sharing crackdown has one analyst feeling bullish. We've got the details for you next. HBO Max raising prices on its ad-free service for the first time since the streamer launched in 2020. Yahoo Finance's Ali Canal has the details for us. Ali, how much more are we going to be paying?
Okay, well, if you're an HBO Max subscriber to that ad-free version, you're going to be paying $1 more. So currently things are $14.99. The new price is going to be $15.99. And it comes ahead of that soon-to-be launched combo service between HBO Max and Discovery later this spring. So it's interesting timing that they decided to raise prices now. Perhaps the $15.99 price point will be the price point of that combo service. We'll have to wait and see. But the company did say in an email to subscribers that the increase will, quote, allow us to continue to invest in providing even more culture-defining programming and improving our customer experience for all users. But remember that Warner Brothers Discovery, they scrapped multiple HBO-specific projects and pieces of content due to the various restructuring challenges at the business, and that greatly angered fans. But that being said, investors really seem to like this move. They like the pricing power there. The stock is up about 4% on the news. And earlier this week, we did receive some positive Wall Street sentiment on this company as well. Guggenheim upgrading shares to a buy from neutral yesterday, while analysts at both Goldman Sachs and Bank of America signaled that brighter days are ahead for this company, despite that messy year that we saw in 2022.
Allows you to see the best show on TV, Succession. You know, I'm paying the extra $1 a month. Netflix also receiving some Wall Street love. What can you tell us there?
Yeah, Jefferies upgrading the stock to buy from hold and increase their price target to $385 a share to $310. And this is due to some of those more longer-term catalysts, like the platform's recently debuted ad tier, along with its crackdown on password sharing. Jefferies estimated that revenue and adjusted EBITDA will come in well above Wall Street estimates in 2024, and that's going to result in some positive margin upside and valuation expanding back towards historic averages. So if you're a Netflix investor, this is something that is going to take some time. You're not going to see immediate changes this year, but perhaps in 2024, we'll be able to see some of the benefits of what Netflix is doing right now. Wait and see. Shares were up a little bit more earlier today. They've pared back some of those gains, but right now, roughly 1%.
Saw a new trailer for the golf documentary out today. That's going to be an interesting one, trying to follow up on the F1 success. I already want to talk to you as well about Disney. Shares trading up almost 4% after a big day of news, quite frankly, for Disney. Naming Nike's executive chairman Mark Parker as its next chairman of the board. But the big one was overshadowed by a looming proxy battle between activist investor Nelson Peltz and the Magic Kingdom. Ali, what is going on here?
Yeah, and it was really fascinating to see in that release, Disney revealing Mark Parker is our chairman, and also in the same breath, we're going to address this fight with Nelson Peltz. And just to back things up a little bit here, Peltz's Tryon Fund purchased roughly 9.4 million shares of Disney, valued at approximately $900 million. So they have some skin in the game. Peltz wants a seat on the board, and he's going to now appeal directly to Disney shareholders to win their support for that spot. But Disney made its position incredibly clear. In that press release, they said, quote, while senior leadership of the Walt Disney Company and its board of directors have engaged with Mr. Peltz numerous times over the last few months, the board does not endorse the Tryon Group nominee and recommends that shareholders not support its nominee and instead vote for all of the company's nominees. So really not holding back there. And Tryon said that it's not looking to push out Bob Iger, but it does want some organizational changes. It wants to cut costs, and it really wants to focus on finding a new CEO of the company. And that's something that Disney has really expressed they want as well.
Yeah, it's going to be interesting, though, to see whether or not those arguments, a lack of succession plan, the over-the-top compensation, whether or not that's going to register with investors, because I think that's a big pain point going forward here, and whether or not that is enough really to get investors on their side, on Nelson Peltz's side. In terms of Wall Street's opinion, it's been a little bit mixed, but Rosenblatt was out with the note, which kind of took me by surprise. And they were actually saying that Peltz's push, despite the board's objections, has merit and could help shares. He then went on to say that Disney repeated succession failures with Iger probably argue for a new set of eyes in the boardroom, and potentially that Peltz on the board would probably make Disney investors more confident that these challenges can be addressed well. So we'll see. I think there's a lot of debate about whether or not this is actually going to happen.
Yeah, look, the interview this morning, a lot of touting of his resume, impressive as it may be, Nelson Peltz, but I don't think there's anything at the core of what he's saying that Bob Iger doesn't already want to accomplish.
Exactly.
He knows he messed up the succession plan. He knows he probably overpaid for Fox at $71 billion. The big question, I think, in regard to what he's saying is Hulu. And that's the big question no one can answer. Will they buy it out? January, 24? They have 3 quarters and Comcast has a quarter. What do you think is going to happen with Hulu?
That is one of Bob Iger's big questions here. And you've heard mixed feelings on the street. Some say it's imperative that they buy out Comcast's 33% stake. Others say, look, if you shop this around, you could be able to, help your balance sheet out a little bit. And you could probably get a really big price tag for that. It'll be interesting to see what direction Iger takes, because Disney really reiterated its confidence in the decision to bring Iger back in November. And they really want him to set the stage for this next CEO. What that means, how that's accomplished, I think remains to be seen. But we've already seen a lot of little things that Iger has done since stepping back in November, that was not that long ago, to try and set Disney up for this next phase of growth.
We'll see.
Going to be very interesting to see this play out. Allie, thanks so much. All right, coming up, Caterpillar shares hitting new highs. We'll tell you why next.
Time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Caterpillar, Taiwan Semiconductor, and Rent the Runway. My pick today is Caterpillar. JP Morgan adding the stock to its analyst focus list, naming it a near-term idea. Now, the bank has had an overweight rating on Caterpillar, saying that its, quote, upside potential is underappreciated by investors. It is a trending ticker on Yahoo Finance today. Shares hit a record high earlier, and you can see gains still up almost 2% on the day. They're up about 7% so far since the start of this year, up 47%, Dan, in the past 6 months. So certainly an outperformer when so many names in the market have really struggled in recent months.
Yeah, and I just want to throw this out there. I got to see a giant 100-ton Caterpillar
at CES.
Autonomous, right?
Yeah.
So I'm sure they can get some of this excitement.
I mean, yeah, it's it's pretty rad. I'm not going to lie. Just being able to see it. I took a video and sent it to my nephew and everything. But my pick for the day is TSMC. They announced their Q4 earnings, laying out weaker than expected guidance for the coming quarter. They said that revenue will be between $16.7 billion and $17.5 billion. Analysts wanted $17.9 billion, but they say in 2023, the semiconductor market's going to decline about 4%. The foundry industry, meanwhile, is going to decline 3%. There, TSMC saying that they see revenue declining between the mid to high single digits versus the same period last year. But oh wait, the second part of the year, they're going to pick things up again. So while everyone else is floundering, they're going to be able to finish the year on the plus side. So they're looking pretty good for their outlook. They say they're cutting costs internally to help manage profitability. And this is something that we've seen throughout the entire semiconductor industry, whether it's Intel, AMD, NVIDIA, or the foundries, really kind of trying to figure out how they can get back to profitability or return to growth, not profitability, return to some meaningful growth as we talk about, this kind of glut that we had or have in terms of chips.
Yeah, and some of it is not in their control. And their CEO in some commentary this morning saying, we continue to observe softness in the consumer end market segment. He really talked about supply chain snarls still being the brunt of their problem across the industry. I hadn't realized that we're still not all the way back. And then he added, to your point there, we expect revenue decline mid to high single digits. But then, second half of this year, they expect things to turn around because the supply chain clears up and then they start popping. So be patient, investors. My play is Rent the Runway. Shares seeing a rough landing, if you will, despite positive news today. The apparel e-commerce platform today making their debut on Amazon. Hundreds of items from their secondhand pre-loved collection, as well as new pieces from their design collection, are now available on Amazon's Rent the Runway storefront, said their CEO and co-founder Jen Hyman in an interview with WWD, quote, "It's not the same as any old brand or any old retailer selling Amazon because of the fact Amazon is helping fuel these tailwinds that normalize secondhand." Shares were actually down 10% earlier today when I picked this as my triple play. And for whatever reason, perhaps this story began to circulate. They have come back up basically flat. Now, it's been volatile, down more than 40% last year, up 25% this year to date. I think this is a very good play for Rent the Runway to get onto Amazon, to have their own storefront there. Seems like a lot of upside for them. They had a rough last 12 months.
They certainly have, and it really brings brand awareness. We talk about that being so important for companies like these that have struggled really to regain momentum after they were hit very, very hard because of the pandemic. When you take a look at their numbers, they have started improving. Last month when they reported their most recent earnings, their active subscribers actually jumped about 15%. So yes, not as strong clearly as what the street would like to see at this point, but certainly we are seeing some improvement there. This Amazon partnership potentially getting more subscribers there onto its site, becoming recurring customers. I think it's a huge win for Rent the Runway, which is maybe why it erased a lot of its earlier decline today.
Yeah, I couldn't figure out why it was down 10% when I found the story, but it may be the macro economy situation sends people towards Rent the Runway in the year ahead. Dan, thanks for playing, my friend. Appreciate it.
All right, well, coming up next, FTX founder Sam Bankman-Fried is talking again. We will talk to a lawyer about what it could mean for his criminal case next.
Former FTX CEO Sam Bankman-Fried taking the internet once again today to defend himself amid the crypto exchange's ongoing bankruptcy case. This time, Bankman-Fried took to Substack, posting a lengthy explainer of why he believes not only that FTX did not misuse customer funds, but also FTX US remained solvent up until when he passed over the books. Here to talk about SBF continuing to plead his case outside of the courtroom is Nima Rahmani, president of the West Coast Trial Lawyers and a former federal prosecutor. Nice to see you. This is just head-scratching to say the least. He says, I did not steal funds. I certainly did not stash billions away. Just on the surface, before we dive into it, if you're his attorney, what are you doing today?
You're cringing if you're Sam Bankman-Fried's attorney. I mean, this is what you're not supposed to do. And the reason is this, it's simple. These types of statements can only be used against you. You can't use these types of self-serving statements at trial. That would be hearsay, of course. So if you're Bankman-Fried's lawyers, you're begging, you're pleading, you're telling him, keep your mouth shut, stay off social media. This is not going to help your case.
Well, certainly doesn't seem like it is helping his case so far. Question for you just in terms of the approach that he's taken so far, basically saying he doesn't know anything, certainly out of his control. He hasn't been involved in Alameda now for months. Any thoughts there just in terms of whether or not that sort of route could potentially help him?
Well, there's two types of defenses in these cases. It wasn't me or I didn't know, and Bankman-Fried's taken the second approach. The problem is you already have cooperating witnesses. You got Gary Wang, you have Carolyn Ellison, who are already pled guilty and who are testifying against him, saying that he absolutely knew what he was doing and he directed them to falsify financial statements and to siphon money from his company. So it's going to be an uphill battle for Bankman-Fried and his defense team.
He didn't mention Ellison. He didn't mention Wang. He did mention the Bankruptcy Counsel, which is Sullivan and Cromwell. He also mentioned General Counsel Ryan Miller in saying this: S&C, Sullivan Cromwell, and the General Counsel were the primary parties strong-arming and threatening me into naming the candidate they themselves chose as CEO of FTX, including for a solvent entity and FTX US, who then filed for Chapter 11 and chose Sullivan Cromwell as counsel to the debtor entities. What do you make of that portion of his blog?
Well, there's always going to be finger pointing in these high-profile fraud cases. We recently saw it with Elizabeth Holmes, right, pointing the finger at ex-boyfriend and COO Sunny Balwani, and of course he was pointing the finger at Holmes. So this is what we're expected to see. The money is gone. Obviously, someone stole it, and even though he's the CEO, the buck stops with him. We're going to probably see some sort of shifting the blame type defense at trial.
How long does something like this could potentially go on for? We've talked to a number of attorneys, a number of defense attorneys here over the last couple of month or two, and they're saying that this could take months, potentially years.
Yeah, these complex fraud cases are difficult to prosecute. And it's actually surprising we got an indictment so quickly, probably because prosecutors in the Southern District of New York thought that Bankman-Fried may flee. We saw a bare bones indictment before the grand jury. Typically, you see much longer indictments in these types of cases. So both from a defense perspective, I expect that we're not going to get a speedy trial here. We're going to see lots of witnesses, hundreds, maybe thousands of exhibits at trial, one that will probably last months. So, strap in your seatbelt. It's going to be a while before we see Bankman-Fried actually present his case to a jury.
There was one sensible thing he did. He turned off the pay option. Initially, there was a button encouraging people to pay $150 to listen to more of this blogging. But let's go back. He's done Twitter Spaces. He's done numerous Zooms. He sat down with Andrew Ross Sorkin and now the blog. Is there anything here to you, Nima, that you can say, all right, here is a substantive defense he might be able to use in the courtroom? I
don't see any because, again, we have those cooperating witnesses. I think the government has a very strong case because he's using these funds for personal reasons. And let's not forget, in addition to these TV interviews, in addition to social media, he was about to testify before Congress the day before he was arrested. And he was going to say he expletive up. So this is someone who clearly thinks he's smarter than everyone else, maybe because his parents are, Stanford law professors. He thinks he has an understanding of the law, but he is doing himself a disservice. And I don't think there's any real defense here.
Do you think a plea deal is the likely end of this story, Nima?
I do think so, because he's looking at so much time. His guideline range is through the roof, almost a life sentence, because we're talking about potentially the largest fraud in U.S. history, billions of dollars. But even if you're looking at that 20-year statutory maximum for the fraud counts, if he's going to try to get anything near 10 to 15 years, like some of these other big fraudsters have gotten, like the Elizabeth Holmes and Balwanis of the world, he's going to have to plead, because if he takes this case to trial, pushes it all the way, and gets convicted, I can see a judge hammering him and sentencing him at or near the max. I know he's young, but he should do what Wang and Ellison did, plead guilty, accept responsibility. But I don't expect that to happen.
No indication of accepting responsibility. Nima Rahmani, good to have you, sir. Thank you. Shana?
All right, well, despite this ongoing trial with SBF, take a look at what crypto is doing, because Bitcoin and Ethereum, Dave, you and I have talked about time and time again, has been very resilient through all of this. But today's jump, Bitcoin up just about nearly 8% above 18,000 for the first time that we've seen that since mid-December. And this jump, a lot of it having to do with that CPI print that we got earlier this morning, showing inflation cooling, that risk-on sentiment back in the market. And we're seeing Bitcoin jump as a result. In the last 2 months, we're looking at gains of just about 12%, which is hard to wrap your head around when you talk about everything that is going on in crypto right now. Taking a look at Ether here, up just around 6.5% today. Over the past 2 months, up nearly 14%. We certainly see this move higher since the start of January. Again, today's huge jump, all of that has to do with a CPI. And as we see Bitcoin and Ether jump, so we also see Coinbase posting significant gains today, up well over 1% as we take a look at that chart, well over 8%, at 47.28 per share. This is a crypto exchange that has been beaten down pretty bad over the last several months, but that tide seems to be turning on that name, at least for now. When you take a look at Bitcoin's jump and really the jump that we're seeing across the board in so many of these tokens, it's funny that this is still happening at a time with the FTX fallout. We don't know exactly what's going to happen with SBF. All right, well, coming up, Attorney General Merrick Garland making a big announcement after the discovery of President Biden's classified documents. We've got the details for you next. Attorney General Merrick Garland announcing he is appointing a special counsel to investigate President Biden's potential mishandling of classified documents from his time as vice president. Garland has appointed veteran prosecutor Robert Hur to the job. Now, Hur served as the U.S. Attorney for Maryland during the Trump administration. The announcement came after the White House's counsel office revealed aides had discovered a second batch of classified Obama-era documents in the garage of Biden's Wilmington, Delaware home. Well, coming up, we are counting down to the closing bell on Wall Street. Once again, holding on to gains as we take a look at all three of the major averages trading to the upside. Dow up 186. We'll be right back. We are just minutes away from the closing bell. Let's take a look at some of today's huge movers. We got to talk about Bed Bath & Beyond. And look at this today, a jump of just about 51%. This comes on the heels of what this stock has been doing pretty much all week. Looking at the fact that it's back above $5 a share. Now, this comes at the time that you would have thought that the struggling retailer would have filed for bankruptcy up until this point. But instead, the stock is rallying despite reporting weaker than expected earnings earlier this week. Bed Bath & Beyond stock is now up more than 200% on the week as meme traders once again flock to this name. And taking a look at that 4-day performance since Monday, you're looking at gains of over 300% actually on our chart here with Bed Bath & Beyond, Dave, back above $5. I don't know.
Trying to find reason and accountability here is just not going to happen. There is no comeback in sight for them. It is just a matter of when, not if. They file. They're going to close 150 stores. It is good night. It is throwing your money and lighting it on fire. But looking at the percent of float shorted, still about half, about 50% short on Bed Bath & Beyond. Say goodbye.
Say goodbye. You got to be willing to, well, I guess, lose it all, to say the least. All right, let's talk about Cleveland-Cliffs because that stock up just about 8.6 this afternoon. The steel producer shares popping after Morgan Stanley upgraded the stock to overweight. Price target of $26, about $6 higher from where it is today. Now, the company is citing higher annual fixed price contracts, which should help the company cope with potentially lower spot steel prices. So again, that stock moving to the upside today, back above $20 a share. And let's take a look at some of the travel names. Look no further than the airlines. Certainly a huge mover here this afternoon. And the biggest mover of them all is American Airlines. And that coming up just at nearly a 10% pop, boosting its EPS guidance, noting revenue should be up nearly 20% from pre-pandemic levels. The rest of the airlines rising on this news. We will be getting earnings from Delta tomorrow ahead of the bell. Now, that, of course, will be a name to keep in mind. The street is expecting earnings per share of $1.30, revenue of $12.22 billion. And taking a look at today's gains, American Airlines up nearly 10%. And Dave, you also have United up, one of the huge gainers as well. Delta in the green. Most of the travel stocks in the green today.
Only three things: eggs, fuel, butter has had a higher increase over the last 12 months than airfares. Airfares up 28.5% year over year, and we are not stopping traveling, fueling those numbers. Let's get to your closing bell on Wall Street for Thursday. There is your closing bell for this Thursday. Let's check out how the markets reacted largely to the positive CPI print we got at 8:30 this morning. If you were up and watching the markets, the futures dropped initially, did not like what they saw in this report, as it was about exactly what estimates predicted. And then they rallied. You see the Dow finishing up 216 points, the S&P a slight gainer at 13, about 0.3%, the Nasdaq up about 70 points on the day. For a closer look at the broader markets, let's bring in Crossmark Global Investments Chief Market Strategist Victoria Fernandez. Nice to see you, Victoria. Your read on what the market saw in the CPI print today.
Yeah, I think you're right. When you speak about the market really going down at first, that kind of knee-jerk reaction, excuse me, when CPI came out this morning, I think it is because every element of that report was as expected. Both headline numbers, core or the headline and the core for year over year and for month over month, all as expected. And I think there were some people out there that really wanted to see that be better than expected because they have the anticipation that then the Fed is going to change their outlook. Nothing that happened today, in my opinion, changes what the Fed is going to do. We've been anticipating for the last couple months that the Fed would do their 75 basis point hikes through the end of this year, and then they would move to 25 basis points for the first two meetings of 2023. We still think that's what they're going to do. Their higher for longer mantra has not changed. You even had Bullard out today saying there's not enough upside risk for inflation that the market is pricing in right now. So it just tells you they're not going to change. And I think that's why we saw so much volatility early on in the markets, combined with the labor information that came out, which is not positive for what the Fed is going to do. All of that was kind of a negative draw this morning, but the markets rallied and they ended up a little bit.
Well, Victoria, what does all this then signal for equities, at least over the next couple of months? If you think the Fed is going to continue on its path right now, continue to raise rates, does that mean we should expect to see more volatility then for the market?
Sean, I think that's absolutely what we're going to see in the markets. You know, last year, our whole theme for the year was a tug of war. And I think we're going to continue to see that. Just because the calendar changed does not mean what's going on in the economy has really changed. And obviously, tomorrow we're kicking off earnings full steam with the banks. That's going to set a tone for sure. But as we go through the next few weeks of earnings, I think that's going to build in with what the Fed is looking at. They've told us they need the labor market to weaken. I mean, look, we had initial jobless claims, continuing claims, the 4-week average for claims all come down. So the labor market's going to continue to be strong. I think the Fed is going to continue to push back against the market. Again, that just means more volatility. So you've got to position your portfolio in order to take advantage of that.
When the Fed looks at this report today, Victoria, what do you think is the most concerning aspect of it?
Well, services is where they're really looking, right? We all knew that the goods component was going to come down. We were going to see deflation there, and we did. Most of that due to the energy component. But the Fed is looking at services, and they're looking at services X energy and X rent, which is really important because the rent component was up 10% annualized in this report. That's huge. If you look at analyst reports, they say that rent is going to actually come down, or it's coming down now, but that's going to flow through the CPI report probably around mid-year, which means the Fed is going to continue to do what they're doing. So they're focusing on that services component. That's where they need to see it come down. And they also need to see the labor market weaken. Hopefully it weakens with more people coming into the workforce instead of laying off more jobs.
Victoria, how long do you think it's going to take? We were talking to Mark Zandi last hour. He was saying that by next spring, definitely next summer, he doesn't think inflation is going to be a concern, that we will reach the Fed's target of CPI of about 2.5%. Do you agree?
Yeah, I don't think we'll reach it this year. So a call for 2024 would align with what we're thinking here at Crossmark. But again, I think so much of it depends on how far the Fed is willing to go. Are they willing to push us into a mild recession in order to get that demand destruction that they're looking for? You've got real consumer spending at over 3%. So that's not demand destruction that's happening. And we've got a dollar that's weakening, Shauna. That means import prices are going to go up. That's a danger. Wages, import prices moving higher, rent staying high, all of that is a danger to inflation continuing to move higher. My thought that I want to really understand with the Fed is, are they willing to accept something higher than 2%? If so, perhaps we can pull forward that deadline a little bit. Are they willing to accept a 3% or something right around 3%? They say no, they're not changing their target, but I think if it goes too long, we might see a little bit of a change there in thought.
Yeah, you can't help but wonder. So the investment thesis in the face of all this is what?
Well, I think for one, it's be cautious. I think it's look at your portfolios and try to have that balanced approach to your portfolio. Have some fixed income allocation. You have the equity allocation, but have a diversified allocation there with some cyclical names, some growth names, some value names. That way, as the market does have the volatility, you're able to take advantage of that. And when you have certain names that run up, for example, Verizon ran up double digits last month, trim a little bit of those names, and then you can go into some names that have pulled back quite a bit that maybe have been on your shopping list and start building that up little by little.
All right, Victoria Fernandez, thanks so much for joining us here to react to today's inflation report. Let's talk about shares of Tesla, because the stock ended the day to the upside, was down just about 2% earlier today. That came after a report from Bloomberg that the company is delaying expansion plans at its Shanghai factory. Prosty Romanian here with more on this. Pros, it looks like maybe investors were a little bit worried about that initially, but again, the stock closing today in the green.
Yeah, big move there late in the afternoon, I guess. We were talking about the story earlier today, and it was down much. But, you know, that's a big story to Bloomberg. They're delaying that expansion that would have been almost doubling capacity to 2 million vehicles a year. You know, there's concern there about the Starlink connections, the Elon Musk SpaceX Starlink company. The Beijing officials concerned about some sort of, you know, security issues, social stability, things like that. You know, it comes at a bad time for Tesla. We saw Chinese protests over the weekend with the pricing issues. We saw these deliveries in December down 40%, and now this expansion now kind of in question. Big deal for Tesla in one of their biggest markets.
All right, Porsche also making some news, Pros, posting a 3% global increase in deliveries in year over year, and also reportedly in talks with Google. What can you tell us?
You know, speaking of integration and technology and maybe spyware, no spyware, but, you know, Google, you know, in talks with Porsche, right? So Porsche before reluctant about adding Google sort of integration to their cars for, like, you know, they want to control that space, control that data. Companies like GM and Ford and Nissan have been using that for a while. Basically what it means is that you'll have native kind of apps in your car without having to go into CarPlay. You can hit Google Maps, Google Assistant, things like that. So they're going to work on that potentially with Porsche there. And, you know, like I said, mentioned Porsche, a great year 2022, another record, 3% up in sales. That's really positive stuff for them. The 911 and the Taycan, the Cayenne selling well, but the Taycan actually, the battery EV car, down 20% in the US. And, you know, Porsche saying not a demand problem, it's a supply chain issue. So still having supply chain issues for that car.
How big are supply chain issues still in the auto industry today?
You know, depending on the manufacturer, you hear different things. So GM, they said they're working through it. That's positive. Ford, some issues. And Porsche, you know, they only built 39,000-ish EVs last year. That's not that much. And they're having issues even doing that. So it makes you kind of question, can these competitors actually take it to Tesla, right?
Yeah. All right, proud Supermanian, thanks so much for that. And also be sure to tune in tomorrow at 11 a.m. Eastern Time as Yahoo Finance Live takes a deep dive into Tesla's stock crash in our latest installment of What Just Happened. Well, beginning next week, Microsoft will let salaried workers take as much time off as they want. The software giant joining a growing list of companies offering their employees unlimited paid time off. The company's chief people officer, Kathleen Hogan, making the announcement announcing the change in an email this week. Microsoft workers will also get 10 corporate holidays, a leave of absence privileges, as well as sick and mental health days and bereavement time. Dave, this is just another example of a company here trying to put their workers first, trying to really do all they can to attract that top talent, to keep their top talent. It will be interesting, though, to look at the trends of whether or not people do take more time off, or whether or not they stay in, because a lot of the survey shows that the companies that offer unlimited time off, their workers actually, in fact, take less vacation.
Yeah, first read, it sounds like, it's a trap. That's the Star Wars reference. I don't know if you know Admiral Akbar. You're probably far too young to know that. But at first glance, yes, it makes you feel like, well, if I take 3 weeks, are they going to punish me? But when you dive deeper into Microsoft's policy, actually, this reads genuine because they have encouraged as much remote time and more workers to work remote as they possibly can. So those people that actually are able to work remote, I think this plays well into someone who wants to go on a 3-week vacation and work from Hawaii or Mexico or whatever it may be. I do generally feel like unlimited time off is a gimmick, is something that no employee is going to take advantage of, because at the end of the day, you all have year-end reviews and you're going to be renewed based on that. And so, I don't think this largely plays out the way it sounds on the surface.
I don't think so, too. And there certainly has been a number of studies looking into this. There was a recent one from Namely, which is an HR company, and they looked into the people that were offered unlimited time off versus those that weren't. And those that were offered unlimited time off, they took an average of 13 vacation days, comparing that to an average of 15 vacation days for workers who were given a set amount. So it's only a difference of 2 days. But the stat that actually stood out to me, or the findings in this report, were that the employees that were given unlimited time off, they were twice as likely as those that were not to work on vacation.
Yes, and there I think is the key with Microsoft.
Yeah.
Let me ask you, if you were offered unlimited time off, how much do you think you would realistically take?
I don't think it would be any different from what I take today. I already don't use all of my time off. I far from use all the time off.
The other read here is that some people fear this is so they never have to buy back vacation days, because built into this new policy, they are in April going to pay off any unused vacation days. So in theory, they will never have to do that again. That is potentially a huge cost savings for a company like Microsoft, because that is the policy that no longer exists.
It's certainly an interesting way to look at it, and also will be interesting to see if some of these other tech giants also follow Microsoft's footsteps and offer that, because we know competition for some of those workers is very, very fierce.
We're so skeptical. Maybe they're just being genuinely caring about their employees.
I like it.
I'm
We'll
going to
leave it
give them
there.
the benefit of the doubt.
Okay, we both should.
All right. Okay, Yahoo Finance's real estate report special begins after the break. Please stick around. You don't want to miss that. This is a Yahoo Finance special real estate report. It's set to be a tough year for the housing market. Higher mortgage rates, the threat of a recession, and tight inventory, all hitting home buyers. But home prices are expected to fall sharply this year. Which parts of the country are most vulnerable, and who will feel the pain the most? Over the next hour, we'll take a look at what's ahead for buyers, sellers, renters, and investors, and where home prices are headed in 2023. Also, remodeling and renovating. When does it make sense to just stay put? Join us right now for this Yahoo Finance special real estate report.
Welcome to this special edition of Yahoo Finance Live, brought to you by Intuit TurboTax. Now, over the next hour, we'll be breaking down what you need to know about buying, selling, and renovating a home in 2023. But let's start with this map right here. Now, what you are looking at is at all the top real estate markets to watch. This is according to the National Association of Realtors. And Dave, weigh in here, because my first take, obviously a lot in the South, but 3 here in the Southeast.
Yeah, what really stands out is what is not covered on this map. Basically anything west of the Mississippi, the entire West Coast is left out. Also New York, Boston, Philadelphia in the Northeast. And why is everything converging in this basic region? No matter what list you see, it's based on 3 things: affordability, jobs, and of course, quality of life. And that comes down to weather, that comes down to outdoor things to do, and that comes down to even the commute that you're not having up in the Northeast and in California. And that's why all the top 10s are centered right there. Yeah. All right, one thing we know for certain is buying a house this year may be a lot harder than buying in 2022. Yahoo Finance's Ali Garfinkel spoke to some hopeful buyers and real estate experts about what it's like navigating today's market. What did we learn?
Hi, Dave. To put it simply, it's rough out there. Here in Southern California, I'm standing in front of this sign that's a for sale sign, right? Part of the problem is there aren't enough signs like this. There's, to put it simply, a massive inventory problem. So what's happening is that it's making things even more difficult for home buyers. Take a look.
We've been looking for a home for, I would say, 2 years, more or less, give or take.
Danielle Cohen and her husband David Jarvie from Los Angeles are facing the same dilemma as home buyers across the country.
It just came to a grinding halt when interest rates went crazy, and now we're just not finding a lot on the market. So
I think a lot of people right now are afraid to list their house, so if they don't have to, they won't.
The average 30-year fixed loan is hovering around 6.5%. But as the Federal Reserve pulls back on the pace of its aggressive rate hikes, the Mortgage Bankers Association expects the 30-year fixed to drop to 5.2% by the end of this year. That's well below the historical average of 7.75%. Ed Fitz is a real estate agent and partner at the agency in Los Angeles.
Buyers are really holding off at the moment for a variety of reasons, including the new interest rates that's changed things dramatically since last spring. Nobody quite knows where the market is going next, either in Los Angeles or California or even nationally.
Also freezing the market, sellers are reluctant to drop their prices. In real estate, the asking price is often as much about psychology as it is about reality. Fitz has gathered data on this through an app he launched called Domicile Game of Homes, sort of like The Price is Right for real estate.
People who are not actively in the market, who are just guessing the prices, what's the asking price, what's the ultimate selling price, are guessing higher than the house actually sells. The mind of the average consumer hasn't caught up to the realities of the market right now.
But sellers are being forced to cut prices. Realtor.com estimates 1 in 5 sellers nationwide are lowering their asking price. The states with the biggest cuts, the western part of the country. Arizona, Nevada, and Utah topping the list. Realtor.com predicts the 2023 housing market could become a nobody's market, not friendly to buyers nor to sellers.
Every time she's around, the energy changes.
We caught up with Jason Oppenheim, star of the hit Netflix series Selling Sunset.
I think we probably saw the bottom of the market at the end of 2022. Probably saw the height of interest rates at the end of 2022. So I'm generally optimistic, but I don't want to pretend that means the real estate market's going to be, on the ascend.
For Danielle and David, they're hopeful they'll find a great home soon.
Yeah, it's just waiting.
But the higher interest rates definitely affect buying power, right?
Yeah.
So the reality is this: while it's incredibly difficult to find a home right now, it's not just a matter of finding your dream home, it's a matter of completing the process altogether. Back to you in the studio.
Certainly is, and it's tough in this environment. Ali Garfinkel, thanks so much. Well, it is a new year, and you may be interested in a new house. Mortgage rates have cooled demand for homes. The number of homes sold is down 37% from a year ago. That's according to Redfin data. We want to take a deep dive into housing markets across the country and take a look at Denver, at Indianapolis, and at Charlotte. We have Kathy Casey, Caldwell Banker, residential brokerage realtor in Denver, Colorado. Dan O'Brien, realtor at True Blood Real Estate covering Indianapolis. And Sir Ashley Harrison, real estate broker at the Harrison Group with Fathom Realty in Charlotte, North Carolina. It's great to have the three of you here. We want to jump right in and get to what you're seeing in your respective regions. We're going to go around the horn pretty quickly. Kathy, let me start with you. What are the trends? What are you seeing in Denver?
So Denver, our market is cyclical. So typically the spring market starts in January. So we are already starting to see signs of the spring market showing that it may be a heated market. In December, the market was kind of slow, and buyers really were taking their time. They were able to really pick and choose what they want, and they were asking for seller concessions and the contingencies that they haven't had the luxury to be able to ask for in the last couple of years.
Dan, what about you? What are you seeing in Indianapolis?
Yeah, things have certainly slowed down since the craziness of the COVID market, right? So things are lasting a little bit longer on the market. Days on market is up, but the median sales price is still up 9% or so year over year. But buyer demand has certainly slowed down with those rising interest rates. And so it's one of those things where we've been seeing new listings coming on the market, but they just take a little bit longer. And the question, like you were talking about, is do sellers, reduce the price? Do they play the waiting game? So we anticipate still a busy year this year. And, time will tell to see what happens.
Sir, how does this compare to what you're seeing in Charlotte?
Pretty similar. We're seeing more inventory, but less new listings, and buyer demand has fallen off, and we are getting a lot more seller concessions, but pricing has remained very sticky.
Sir, I want to stay with you because we mentioned the top 10 markets all basically in your region. North Carolina is on fire. What do you make of it? What makes North Carolina such a perfect storm for real estate markets right now?
Well, affordability. You named it earlier in the segment. Affordability is the driving point, and a lot of industry is coming to the Carolinas and North Carolina in particular. Just this past year, North Carolina was ranked #1 by Wall Street Journal as the #1 place to do business. So I think that's the main driving point.
Kathy, when you take a look at Denver's housing market, it's incredible taking a look at the prices because they have certainly exploded. They're up 30% when you compare it to the levels that we saw back in March 2020. What is that doing for demand? And I guess, where do you see prices headed? How long until they really come back down?
So, our prices luckily have been pretty much holding steady. I mean, we lost about 5% since the interest rates started to have that uptick. But the prices are still holding steady because inventory is still low. So, for buyers, this is a great time because now, the line's not as long for you to get into a house. So you can get into a house much easier than you could months ago. And, we have a saying in our industry that is, date the interest rate, marry the house. So go out, find a house that you like and you love, and then, wait till, you can get that interest rate at, that's more for 30 years, that's going to be more appealing to you.
The inventory story has been bleak across the country at best. However, not necessarily the case in Indy. What are you seeing there, Dan?
Yeah, so I mean, year over year, we're up 75% from this time last year. However, to put that in perspective, we just now broke, the number where it was pre-COVID. So before March 2020, when the market went crazy, we're just now getting back to then. And at that time, we were talking about low inventory anyways. So, a lot of people talk about the last 6 to 12 months, but putting in a big picture view, we are still, low in inventory. It is technically a seller's market, but things are looking pretty good leading into the year.
So you're right in the middle of one of the hottest housing markets, if not the hottest housing market. What are some of the tips for people who are interested in or maybe looking to buy in Charlotte?
Yes, I say right now, if you have been on the margins and could not get your offer accepted in the past 2 years, now is the time to move. Although interest rates are a little higher, you're not competing with as many people. So the sellers weren't considering your offer. Now they will consider it, and they may offer seller concessions.
Concessions have been a theme across the country, just like low inventory. Redfin says 42% of home sales in the fourth quarter gave concessions. Kathy, what type of concessions are sellers forced to offer right now?
Right now, sellers are offering to help with the interest rate increase. So they are offering 2-1 buy downs. And if you don't know what that is, basically what that means is for the first 2 years, your interest rate would be lower than it would lower at the market rate right now, the current market rate. So they're offering that. Typically, that costs somewhere between $10,000 to $20,000, depending on how deep they want to cut the interest rate. And that's what's really helping buyers really get into the houses that they want to, because affordability is key here in Colorado. Just to give you some perspective, our home prices have doubled in the last 10 years. And so, wages just can't keep up with that. So anything to help the buyers get into the house is what sellers are doing right now.
Dan, what about concessions in Indy? Is that something that's becoming more and more popular? And what are people offering?
Yeah, same thing here. People are getting creative with the mortgage lending. Different banks are offering different types of mortgage products to help with that increased mortgage rate. Also, sellers, again, similar, are offering a credit for a 2-1 buy down, or just in general to buy down the interest rate to make that more affordable for a buyer. Now we actually have buyers that are being protected by contingencies like inspection and appraisal, where a lot of times those were out the window during the peak craziness of the COVID market. And so it's not getting too crazy or anything like that, but sellers are absolutely having to negotiate. Gone are the days of, hey, my next door neighbor just sold last year for $100,000 over list price. Things are still happening where there are some hot areas that are demanding multiple offers in a matter of days, but sellers are having to actually come back and come to reality with negotiating like they used to.
Sir, what are you seeing in terms of concessions, and what in this market, as we're coming out of COVID, really with the new dynamic, what's the number one thing you recommend that helps move a house today?
Yeah, thank you for that. The concessions I see are paying for closing costs and to buy down the interest rate right now. And it really depends on the loan the buyer's getting and how much concessions they can ask and seek from the seller. The main thing I think buyers can do moving forward is to, one, study the market. Know exactly what's happening. Don't assume just because the market is totally different than last year. Study the market, but also surround yourself with trusted professionals. That's the biggest thing.
Kathy, investor activity has been a huge story when it comes to housing. A lot of the pricing being driven by the jump that we certainly have seen in investor activity. How much of that are you seeing in Denver?
Well, I can tell you, I probably get a call, at least 3 or 4 calls a day from investors when they don't have anything off market that they can fix up and flip, because it's really that tight for investors right now to find anything where they're going to be able, and pricing is kind of a guess, and not only say a guessing game, but you have to be really strategic. You have to really know how to price things. So investors, want to make sure they're going to be able to get that return on investment. So if they can't get it for a really just awesome price, then, it's really not worth it to them, because the uncertainty of the market has got them a little wavering in their decisions for investing into the market right now.
Dan, what's the investment activity in the Circle City?
Yeah, it's been very heavy. It's jumped from, I think in 2020, it was about 8 or 11% of the purchases were to investors, and 2022 is over 25%. So 1 in 4 houses is being sold to an investor right now. And you have some of these billion-dollar companies, Tricon, BlackRock, all these people with billions of dollars, and they can park it into a hard asset like real estate. And it's been really difficult, especially for first-time homebuyers, to compete with these all cash, no inspection, no appraisal offers. And it's also made it difficult for the rental market as well. Rent is up, 20% year over year. And so it's been a really difficult thing to combat. How do you, can you create laws to prohibit some of these big billion-dollar companies from doing it, but not impede on individual rights for, people that want to own investment properties as financial planning? But investment has definitely been a difficult topic here recently.
It's certainly amazing to really take a look at the uptick in activity. We want to go around the horn once again. Quickly, just get your thoughts. Sir, first to you, your top prediction for the housing market this year.
I think interest rates will come down to the low fives, but it'll be harder to get a loan. And it's going to, at least in my area of the country, prices will level off, but tend upward.
Kathy?
So I predict that we have about 90 days of this interest rates will still be kind of maybe even on the uptick. And then I think that they will start to come down as well. And I believe that our prices will continue to hold. And so if you're looking to buy, don't wait, because you want to get out there before the rest of the market jumps back in. That's been on the sidelines.
Dan, you got the final word. Your top prediction for 2023.
Yeah, very similar. So I think mortgage rates will level off, come back down towards the end of the year. Buyer activity will then pick back up. I don't anticipate any kind of decrease in value, anything like that, maybe plateau, but normalize back to a normal level.
All right, Dan O'Brien, Kathy Casey, Sir Ashley Harrison. Nice to have the latest from Indianapolis, North Carolina, my hometown of Denver. Thanks to all of you. Coming up, Jason Oppenheim, founder and president of the Oppenheim Group and star of Netflix's Selling Sunset, gives us his take on the luxury real estate market. Don't go anywhere. Quick though, before the break, let's take a look at our real estate snapshot of El Paso, Texas. El Paso's median home price of $241,000 and median rent of $1,600 makes this Texas border town one of the most affordable cities in the United States. We're back in 2 minutes. When it comes to real estate, everyone is feeling the pinch of the economic downturn, and that includes the luxury home market. Our own Allie Garfinkel caught up with Jason Oppenheim, the star of Netflix's Selling Sunset, to get his take on high-end housing.
We're here with Jason Oppenheim, owner of the Oppenheim Group and star of Selling Sunset on Netflix. But before we get to Selling Sunset, we're gonna talk about selling real estate. So what I've been hearing is a lot of doom and gloom in the market. Give us a reality check. What are you seeing out there?
I'm not the doom and gloom type. I think we probably saw the bottom of the market at the end of 2022. Probably saw the height of interest rates at the end of 2022. So I'm generally optimistic. But I don't want to pretend that that means the real estate market's going to be, on the ascend. I'd say we're probably in for like some type of homeostasis, like just not much growth, probably not much, downward either.
Do you think, you said we've kind of reached what might be a homeostasis too. For you in your business day to day, what does that look like?
Well, we're going to have a rough couple of years, I think, because volume is down. So when I look at real estate, I guess there's two things: prices, which is really what the people care about, and then there's volume, which is what real estate agents care about. In terms of prices, I think there's going to be some stability, which is probably healthy for the market. We can't have that kind of, we don't want the spikes and downs. So I think we're going to see a relatively healthy market over the next few years in real estate as it relates to prices. And we've got a lot of people that own homes that have very low interest rate loans, and they're not going to be selling. So we're going to have low supply generally, probably low-ish demand.
What are kind of some of the concerns you're seeing that transcend income brackets?
Interest rates largely transcend income brackets, although I think affect more the lower income brackets. That is really the hardest. I mean, people talk about affordability of homes. Really, it's the down payment. You got to come up with a down payment. That's always been difficult. But now not only do you have the down payment, now you got to pay a 5 or 6% interest rate, even on a 5 or 10 year fixed. I think that will come down in the next couple of years. So I don't think it's a big deal if someone goes in and buys a house and has a 5% interest rate. And I don't recommend people getting 30 years anymore. You should probably get a 5 year. Probably you're going to be able to refinance in a few years. And buying's always better than renting if you can hold the asset and you can ride the ups and downs and you can take advantage of the appreciation over a decade or 2 decades or hopefully 3 decades. Then I think buying really always makes sense. Doesn't make sense always in the short term. You've got transaction costs, and you're limited in your mobility when you're an owner. You're dealing with a lot of hassles when it comes to the roof leak. It's not the landlord's fault anymore. Now it's your problem. So if you're looking to own and just for a couple of years, probably consider renting.
And here in LA, where, when people are buying now in the situations where they are, where are you seeing the money come from? What professions generally are they in? Are there any kind of trends you've seen in the cases where people are bucking the overall slowdown?
There's a lot of wealth out there still. So, I'm not concerned about the luxury market. Honestly, I'm not even really that concerned about any of the markets. There was an open house yesterday for a $1.6 million house up in the hills. 300 people came by the open house in this environment with these interest rates. So there's still demand out there. I think it's good. 2 years ago, even a year ago, everything was selling. I don't think that's healthy. I mean, crap was selling. And I think that developers and people should be building quality product. And I think people should be more discerning and not being, a year ago, literally you'd get 10 offers on a crappy house with no yard. Now, I think, again, it's back to a healthier market.
My sense that what I'm kind of getting from you is that despite the doom and gloom narrative out there, there is right sizing happening, and there's also a lot of reshuffling going on from where you sit.
Yeah, I think COVID changed a lot in our psyches. The at-home work, people focusing more on the house, more willing to move out of the city. You look at some of these states that, were laughed at a few years ago, and now they are, where everyone's moving. Austin, Texas, and Miami, and Las Vegas, and like Scottsdale, Arizona. These were not places people took as seriously as they do now. That trend is not going to, obviously we're going to see some people coming back into the big cities. I think New York and Los Angeles will be fine. And I think those cities will have some difficulty the next couple of years, but they're on the map. And now there's competition. You don't have to live in LA, you don't have to live in San Francisco, you don't have to live in New York. You can now live in these other cities. And I think that's going to be a draw away from some of the big cities if we can't get a handle on some of these macro issues that we're dealing with. I hope that we can. Like I said, I'm generally an optimist. I think that people that make money in real estate and pretty much anywhere have to be optimistic.
And last thing I wanted to ask you, Jason, in the middle of all this, right, Selling Sunset blew up, right? I'm sure you haven't been asked about it ever.
Yeah. I'm just surprised it took this long.
It took this, yeah, what can I do? What can I say? I wanted to surprise you, but my question is actually not about Selling Sunset itself, but why you think it was so popular.
I've thought about that, and I think it's because it checks a lot of different boxes for a lot of different people. And I realize that because of the people that come up to me. It's such a wide swath and a different demographics all the time.
How wide are we talking here?
I mean, you just wouldn't believe. Well, to every country I go to, I've probably been to a dozen countries in the last couple of years. And it's just every age group, every ethnicity, I mean, it could be from like a football player to like a 7-year-old girl to like a 85-year-old man. I mean, it's so weird. So I think, again, there's different check boxes. Real estate is just fun to watch. That's my favorite thing about the show. And I think that's probably what ties in so many different demographics of people. Then I think the beautiful women and just the beautiful women. And the fashion, I think a ton of people love the women's fashion, and I'm trying to do what I can now. Los Angeles, Sunset Strip, all the kind of restaurants and nightclubs and lounges and cafes and that kind of thing. So and then of course there's the real world drama among, successful, beautiful women that are really striving to, take control of their careers. So there is a lot for everybody.
Thank you so much for joining us, Jason.
Yeah, my pleasure. Thank you for everything.
That was founder of the Oppenheim Group and Netflix's Selling Sunset star, Jason Oppenheim. Well, coming up, it's one of the biggest issues facing the housing market right now, higher mortgage rates. Our next guest tells us what buyers need to know. Stay with us. Welcome back to our real estate report brought to you by Intuit TurboTax. Mortgage rates, they soared in 2022, the largest yearly jump on record. And those rising rates are keeping many would-be home buyers on the sidelines. Let's put all of this in perspective for you. The latest data out from Freddie Mac showing that the rate of a fixed 30-year mortgage is now at 6.33%. That's nearly double what it was a year ago when it was at 3.45%. So here's what this means for you, the potential home buyer. We use Bankrate's mortgage calculator, which takes into account a number of variable costs, and those include credit score, property tax, and also homeowners insurance. So say you're looking to buy a $500,000 house, putting 20% down, which means that you're going to be paying $100,000 up front. That means that your monthly mortgage payment will be $2,878 a month. But if you bought that same $500,000 house a year ago when the rate was almost half what it is today at 3.45% and you put 20% down, once again, your monthly mortgage payment would be $2,180 a month. That's a difference of $698 a month, $251,000 in interest over 30 years. When you take a look at those numbers, take all of this into account, it's no surprise that the sharp rise that we're seeing in borrowing costs driven by the Fed's rate hikes has certainly cooled the housing market, David, and has put home ownership out of reach for so many people.
Right. On the other hand, they are relatively low historically speaking, as just most people forget how high they were some 20 years ago. Shauna, excellent work. Let's talk more about mortgage rates with Melissa Cohn, William Ravis Mortgage Regional Vice President. Melissa, nice to see you. Thanks for coming on. Where do you see these rates flattening out, and what do you think will be enough to really thaw what has become a frozen housing market?
Well, I think the good news is that we are seeing that inflation is moderating and cooling, as we saw this morning with the CPI number. And we're seeing other signs of weakening in the economy, and that means that bond yields are coming down. The 10-year Treasury was at a 3.45 the last time I looked at it. And, mortgage rates have declined by almost a full percentage point since they peaked in November. And I think that we can expect mortgage rates to go down another quarter or even as much as 0.5% over the course of the next month. It's the beginning of 2023. Everyone is back to zero in terms of meeting their goals, and everyone has to, bring loans in the door. And I think banks are going to sharpen their pencils. They're going to tighten up their margins and do whatever they can to bring volume in the door, and lower rates will bring, more real estate transactions. We also saw another figure that refinancing was at the highest level it's been in a while as rates have declined.
Do want to follow up on that refinancing in a second, but what would you tell those buyers who have been sitting on the sidelines waiting for rates to return to that mid to low 3 level in order to get back in on this market?
Well, I think people can't expect that we're going to go back to a 3% 30-year fixed rate. That happened because of COVID and the pandemic, and we don't want to find ourselves in that position again. If we can get interest rates to go back to where they were pre-COVID, call that anywhere from 3.75% to 4.5%, that would be a home run. But buyers need to, my favorite expression is you marry the house and you date the rate. So they want to find a way to get into the house today. You'll generally find that when mortgage rates are higher, that real estate prices tend to be a little bit softer. And when interest rates do come down, and they will come down more than just the 1/4 or 0.5% over the course of the next year and a half, real estate prices will start to go back up again, and there'll be more competition for the homes on the market.
Melissa, for the first-time home buyer, I think applying for a mortgage sounds very daunting. A lot of people don't know where to turn. What is your advice to that first-time home buyer in terms of what they need to know when doing that?
Well, I think that they need to, first of all, be willing to take into consideration looking at an adjustable rate mortgage. Looking at a 5 or a 7-year adjustable, that means that rate's fixed for the first 5 or 7 years, and it's the same thing as a fixed rate for that initial period, but the rate is going to be lower, and it'll make the home that much more affordable. They also need to make sure that they've done everything to keep their credit scores as high as possible, because in many banks price rates based on someone's credit score, and to make sure that they have sufficient money for the down payment and for reserves. We find a lot of first-time home buyers getting stuck because they maybe have enough money for the down payment, but haven't taken into consideration all of the closing costs and what you need to have for reserves. And the last thing is, in terms of looking at your credit, make sure you have enough credit. So many people today, especially younger people, tend to live off of a debit card or perhaps just one credit card. And many of the banks with better rates are going to want to see someone having 3 to 4 different active trade lines on their credit history.
Those ARMs adjustable rates certainly come with the downside. What's your word of warning to people that do go that route?
Well, I think the risk that you have with an adjustable rate is that either that you've had some sort of negative work issue where you no longer qualify to refinance, or for whatever reason, if the value of that home drops, you may not have the equity to refinance. But if you're locking in for, I say a 7-year adjustable is a safe period of time, you're going to mitigate those risks. Really the goal is what can you do to get into a house today and then be prepared to refinance when fixed rates get down to a more acceptable level if you think you're going to be in that home long term. Most first-time home buyers are not in their home for 10 or 15 years. The average, tenure of that home is probably closer to 7 or 8 years.
Melissa, going back to that advice here for the first-time home buyer, you mentioned the down payment, how critical that is. People need to think about not only what they're putting down, but also budget for what they will be paying on a monthly basis going forward. 20%, that often is the number thrown out. Is that the best number, aside from obviously an all-cash offer, for a person that is buying a house to put down?
Well, the benefit of putting 20% down is that you don't have to have the mortgage insurance. So that saves you on a monthly payment. If you are a first-time home buyer for a conventional loan, which now goes up to $726,000, except in the high-cost areas where it's even higher, over $1 million, you can put down as little as 3%. But you obviously, the less you put down, the higher the payment and the higher the mortgage insurance that you're going to have to pay on top of the mortgage payment, the insurance, the taxes.
Melissa Cohn, William Ravis, Mortgage Regional Vice President. Thanks so much for joining us here this afternoon. Well, coming up, a new survey finds that more homeowners would prefer to renovate their homes than move in the current market. We will break down the latest home remodeling trends with Dave Mars of HGTV's Fixer to Fabulous next.
is what I'm talking about. The house didn't come down. That was a great start to the job.
That was Dave Mars, the co-host of HGTV's Fixer to Fabulous, alongside his wife, Jenny. Now, for 4 years, the couple has taken us with them as they update and transform classic homes in their hometown of Bentonville, Arkansas. Dave Mars is here to share his knowledge as a builder and general contractor to tell us everything that we need to know about home renovations. Dave, it's great to see you here. Certainly, we have seen a massive uptick in people wanting to renovate their home. There was a recent Discover survey out finding that 79% of homeowners would rather renovate their homes that they move, the homes that they're in right now, then move. I'm curious to get your perspective on this as a home renovator. What are you seeing, and how big of an uptick have you seen in activity?
So hello. I could not agree with you more. The amount of remodel calls that we are getting now compared to even just a couple years ago it's just significant in so many ways. And I think, like the last person that you had on, interest rates is one of those big things that, these people are in these homes at 3% and 4%, and they just don't see, they can't move to another home. So they're renovating what they have.
And we've seen the pandemic really shift where we want to live, but also how we want to live. What's the biggest change you've seen in the renovations people are asking for?
I think before the pandemic, you saw a lot more of people, they were in the bigger cities because that's where they worked. Where now, there's a lot of people that can live wherever they want and work from home. So we're seeing a big, like people that their house was fine before because they were gone 60 hours a week. Now they're realizing, I'd really like to get that kitchen remodeled, or I'd really like to, make an office, make a space that I can work from. So I think it's more just spending more time in your home and realizing some of those things that you just had kind of lived with in the past that now you really feel like you should change.
And Dave, the cost of all this, we talk about it time and time again here at Yahoo Finance, inflation, the impact that has had on so many of your materials. How much more expensive are renovations today than they were 2 years ago?
They are significantly more. And I think it's everything, like you're seeing in food, like you're seeing, in transportation, you're seeing it across the board. We have the same trucks that the diesel is higher. We have the same, import issues, the same, there's a lot more people in the past 2 years that were buying houses. So builders were a lot busier. So getting materials, everything's supply and demand in our market, and it's gone up a lot. Luckily though, with housing, that's usually people's biggest investment. And, even though the house prices have slumped a little bit here in the last few months, they're significantly higher than they were, pre-pandemic.
Dave, the cost of renovating is more, but the supply chains have also made it far more difficult. Are you seeing easing in terms of the time it takes to get the materials you need?
Yeah, we're seeing a little bit. You still, before the pandemic, you could order windows and 4 to 6 weeks have them, where it's double that now, but it's come down from 18 to 20 weeks. And so it is easing. And I think, that comes down to supply and demand, with not as many homes being bought and sold. So a lot of that is helping. Our labor costs are starting to fall a little bit from what they were. It's getting better, but I still think we're just in a new normal from the pre-pandemic levels, and it's just higher than it was, and it's harder than it was to get materials.
Dave, if you're a homeowner out there, you're debating whether or not you should pour the money into a home renovation. When do you know when it makes sense and it will increase the value of your house versus when it doesn't make sense?
Right. So, number one, I would decide, do you want to live in this house? Do you want to stay here? And if that's the case, let it be a reflection of your family. Let it be something that you enjoy. You're spending a lot more time in it. And, Jenny and I always say, if you're going to just build a house to sell or build a house for someone else, that's fine, but we're really, like, a lot of the homes that we're remodeling and a lot of the remodels we're seeing now are people that they've found the area that they love and they've found the location that they want to be in with the community that they live with. And so there's so much value in that. So now they're just making the home a reflection of what they've always wanted it to be. And I think if all of those boxes are checked, then spend the money. This is, again, it's a great investment, something that is most people's best investment, and you're going to raise a family in there, so you better enjoy it.
Conversely, Dave, for those people that do want to make a renovation that they'll see value from if and when they do sell the home, what types of renovations best hold their value?
So, you think about a house, like what ages? I would say a bedroom never really ages. It's 4 walls. You can change the paint. It's pretty easy to do, but where your fixtures are, like kitchens, bathrooms, those are big areas that you can make improvements to where you can see the money, you can see the return on it. A lot of what we're doing now, we're doing a lot of exterior, a lot of patios, and I don't necessarily know that that's adding a lot of value to the house. But it's raising the standard of living to the family that is there because they're spending more time there. So, you've got to balance I think your enjoyment of the home as much as the resale of the home.
I bet you've got a killer patio. Can't wait to see that. I'm checking out your Instagram feed right now. Catch him on Fixer to Fabulous. He's the co-host, Dave Mars. Great to have you here on Yahoo Finance. Thanks, my man.
Thanks a lot.
All right, coming up, one area of housing that is starting to see some relief is rent prices. We'll break down what renters can look forward to this year after the break. But before we go to break, take a look at our real estate snapshot of Raleigh, North Carolina. With a median home price of $460,000 and median rent of $1,865 per month, North Carolina's capital city is still one of the hottest real estate markets on the East Coast in 2023. Stay with us. Welcome back to our Yahoo Finance Real Estate Report, brought to you by Intuit TurboTax. Renters may finally get relief in 23 as the housing market is expected to continue cooling in the coming months. The national median rent dropped for the fourth consecutive month in December, with overall prices down 3% since August. Here to explain is Yahoo Finance personal finance reporter Rebecca Chen. Rebecca, nice to see you. So what can renters expect to see in 23?
Yeah, so in 2023, most experts are believing that rent will drop and renter can expect some kind of relief. In December, we did see 4 consecutive straight months of rent declining, and that is probably one of the biggest drop we've seen since July 2017, almost 5 years ago. And as you can see, there's really 2 reasons why experts believe that rents could drop in this coming year. And the first is really, many of them are predicting some kind of recession, even if it's a mild one. A mild recession can have this impact on rent. Unemployment could go high and people could be saving more or more conscious of their budget. And there is another reason why experts are seeing some kind of relief coming in 2023, and that is the fact that there could be more inventory coming online for many of the cities in the United States. Construction activities has gone up in certain cities, and as that supply grows, we could see rent coming down for many in 2023.
And Rebecca, despite the fact that we are expected to see a drop here in rent on a nationwide basis, there are still certain cities, Salt Lake City, for example, where rent continues to climb. What's behind that?
So some cities, we are seeing cities where rent is still climbing even in today's market. And it could just be because they're a little bit behind. They're still a little bit delayed reading the economic outlook. One of the agents that I have talked to, though, did say that in certain cities where traditional market that are more popular with jobs, those cities are making a comeback now that pandemic is behind us. So somewhere like Los Angeles could be seeing a rental maybe not drop, maybe staying somewhere the same, or even raise a little bit just because people are coming back into the office and supply has not been solved in cities like this. So even though we are expecting an overall drop in rental prices in 2023, we could see a couple places where renters are still going to see a little bit of that crunch there.
So not everyone will get that relief that they are hoping for. Rebecca Chen, great stuff. Thank you. Well, coming up, we recap what we learned in today's real estate report. But before we go to break, take a look at our real estate snapshot of Boise, Idaho, with a median home price of $483,000 and median rent sitting at $1,900. Idaho's state capital remains one of the fastest growing cities in America. We'll be right back. Welcome back. Now, for the last hour, we have been looking at all aspects of the housing market, taking a look at the various regions, what is driving the housing market. And Dave, despite the challenges that remain in the near term, one overall theme I really took from today's special is the fact that so many people are upbeat about what we would likely see at the end of 2023 going into 2024. And the advice that we got from some of the realtors at the start of the show, especially in Denver, saying that don't necessarily wait until the housing price drops. Right now, she's not expecting that to really happen anytime soon. Her advice to buyers was get in now. You can always refinance. She said date the rate, marry the house, saying you could always refinance when rates drop. So that was her advice today. I love that.
I think what my big takeaway is here, the pandemic has, well, changed everything for everyone, but it really has remodeled the real estate market and it's changed the entire map. It's changed where we want to live and how we want to live. And primarily, it's put quality of life back where it ought to be on top of that list. And that's why we see maps just like this. But we see it across the country. Boise, Idaho. We see it in Phoenix, Arizona. We see it in Nashville, Tennessee. People are moving to places that their quality of life is now higher, and they're also making the same renovations that make their quality of life. And I too think the dire predictions will not come true. Low single-digit home declines in 23. This market's resilient. It's going to be fine.
Yeah, affordability, really the key driver here in the housing market going forward. All right, that'll do it for us today on Yahoo Finance. Thanks so much for sticking with us.